In March of 2020, two friends, Maya and Daniel, are staring at the same red numbers on their phones. They're both 35 years old. They both have $100,000 invested in a low-cost S&P 500 index fund. They both earn solid salaries. They both tell themselves they are long-term investors. And then the market falls off a cliff. By March 23, 2020, the S&P 500 is down about 34% from its February high. In just over a month, Maya's account drops from $100,000 to roughly $66,000. Daniel's account does the same. Maya feels sick. She sells everything and moves to cash. Daniel feels sick too. He almost sells. He opens the app 3 times, but he doesn't click the button. Same crash, same starting amount, same fear. One chooses safety, one chooses inaction, and 5 years later, the difference between them is not a little bit of money. It's life-changing. So what if you never sold during a market crash? Here's the mechanism almost nobody explains clearly. A crash does not just test your intelligence, it tests your timeline. When the market is calm, long-term investing sounds easy. You hear phrases like, stocks go up over time, or stay the course, or buy and hold. But those phrases are almost useless when your account is falling faster than your paycheck can refill it. Because in a crash, your brain is not calculating 30-year averages. It is trying to stop pain right now. Maya is not irrational, she is human. She looks at a $34,000 loss and thinks, if I don't sell now, this could become $50,000, or $70,000, or everything. Daniel has the same thoughts. The difference is that he understands one uncomfortable fact. Selling during a crash turns a temporary decline into a permanent decision. Before selling, both of them own the same number of shares. Their shares are worth less today, but the shares still exist. If the market recovers, those shares recover with it. After selling, Maya no longer owns the recovery. She owns the cash, and cash feels safe at the exact moment it may become expensive. Let's put numbers on it. At the start of 2020, Maya and Daniel each have $100,000 invested in an S&P 500 fund. When the market falls 34%, their accounts fall to about $66,000. Maya sells at the bottom, not perfectly at the bottom because nobody knows the bottom in real time, but close enough. She tells herself she will reinvest when things feel stable again. Daniel does nothing. No heroic trade, no brilliant prediction. He just stays invested. Then the strange part happens. The market starts recovering while the news still looks terrible. By August 2020, the S&P 500 has already regained its February high. By the end of 2020, despite a global pandemic, lockdowns and unemployment spiking to 14.8% in April, the S&P 500 finishes the year up about 16%. Daniel's $66,000 doesn't just stop falling, it climbs back. If he began with $100,000 at the start of the year, by year end he has roughly $116,000 before dividends and small fund differences. Maya is still in cash, and this is where the psychology gets cruel. When her account was falling, selling felt like protection. But when the market starts rising without her, buying back in feels dangerous. She thinks, this rally can't be real. The economy is still bad. I'll wait for another dip. That second dip never comes in the way she expects. By the end of 2021, the S&P 500 gains another 27%. Daniel's account, which was around $116,000 at the end of 2020, grows to about $147,000. Maya's cash is still around $66,000, maybe a little more from tiny interest, but in 2020 and 2021, savings accounts were often paying well under 1%. So after 2 years, Daniel is up nearly 47% from where they both started. Maya is down about 34%, same original investment, same crash, completely different result. After 2 years, Daniel has roughly $147,000. Maya has roughly $66,000. The gap is about $81,000. Then comes the plot twist. In 2022, the market falls again. Inflation hits levels Americans had not seen in decades. In June 2022, US inflation reaches 9.1%. The Federal Reserve raises interest rates at the fastest pace in years. Stocks struggle, bonds struggle, headlines turn dark again. The S&P 500 falls about 19% in 2022. And suddenly, Maya feels vindicated. She tells Daniel, "See, this is what I was worried about." Daniel watches his account drop from about $147,000 to roughly $119,000. That hurts a lot. Maya, still sitting in cash, has avoided the 2022 stock market decline, and now cash is finally earning more interest. Treasury bills and high-yield savings rates climb. For the first time in years, doing nothing in cash feels smart. This is the part of the story most investing charts skip. The person who sells during one crash may look wrong for a while, then right again later. Markets do not move in a neat moral arc where patience is rewarded every single month. Sometimes patience looks foolish. Sometimes fear looks wise. But the bigger pattern matters. A famous study from J.P. Morgan looked at S&P 500 returns from 2004 through 2023. If you stayed fully invested for those 20 years, your annualized return was about 9.7%. But if you missed just the 10 best days in the market, your return fell to about 5.5%. Missed the 20 best days, and it dropped to around 2.8%. And here's the trap: some of the best days happen right next to the worst days. In March 2020, the market had both historic crashes and historic rallies. On March 16th, the S&P 500 fell about 12%, one of its worst days ever. On March 24th, it rose more than 9%, one of its best days ever. If you sell to avoid the bad days, you often miss the rebound days too. Maya's problem is not that she made one bad decision, it is that selling created a second decision, then a third, then a fourth. When to sell? When to buy back? How much to buy? What if it falls again? What if it doesn't? Daniel, weirdly, has fewer decisions to make, and fewer decisions means fewer chances for fear to take over. So in early 2023, Daniel does something counterintuitive. He keeps investing even though he is not fully confident. Daniel has been adding $500 a month the whole time, through the crash, through the rebound, through inflation, through the 2022 decline. Maya stopped adding to her investment account after she sold. She kept saving the $500 a month, but she put it in cash because she wanted to wait for clarity. Now let's fast forward. From January 2020 through the end of 2025, the S&P 500 goes through a pandemic crash, a massive rebound, a bear market in 2022, and another strong recovery. In 2023, the index rises about 24%. In 2024, it rises about 23%. By late 2025, despite all the chaos in between, the market is far above its 2020 lows. Daniel's original $100,000, assuming it tracked the S&P 500 and he stayed invested, grows substantially. With the broad market roughly doubling from the March 2020 bottom by later years, and with his continued $500 monthly contributions, his account could be around $240,000 to $260,000 by the start of 2026, depending on exact contribution timing and fund costs. Maya's path is very different. She sold at about $66,000. She saved $500 a month for 6 years, adding $36,000 in cash. Even if her cash earned an average of 2% to 3% as rates rose later, she might have around $105,000 to $112,000 by early 2026. That sounds responsible. She saved consistently. She avoided some volatility. She did not blow the money. But compared with Daniel, she may be behind by more than $130,000. That is the hidden cost of selling during a crash. It is not just the loss you lock in, it is the compounding you step away from. And this is not only a 2020 story. During the 2008 financial crisis, the S&P 500 fell about 57% from its October 2007 peak to its March 2009 low. That was not a normal dip. That was terrifying. Banks failed, home values collapsed, unemployment eventually reached 10% in October 2009. If you sold near the bottom, it felt completely reasonable. But from the March 2009 low to the end of 2019, the S&P 500 rose more than 400%, not including the full effect of reinvested dividends. The recovery did not require perfect optimism. It required still being there. The same pattern appears after the dot-com crash, though with a longer and more painful wait. The S&P 500 peaked in 2000, fell nearly 49% by 2002, recovered, then got hit again in 2008. Some investors waited years just to break even. That is real. Staying invested is not magic. It does not erase time, pain, or bad valuations. But selling low rarely solves the problem unless you also know when to get back in. And almost nobody knows that consistently. So what would you do? Imagine your account falls from $100,000 to $66,000. Not in a spreadsheet. In real life, your phone buzzes with bad news. Your friends are selling. Experts on TV say it could get worse. Your stomach tightens every time the market opens. Would you hold? Would you sell half? Would you stop looking? The answer is not about pretending crashes don't hurt. They do. A 30%, 40%, or 50% decline can make even experienced investors question everything. The real question is whether your plan only works in rising markets. Because if your investing strategy depends on feeling calm during a crash, it may fail exactly when you need it most. Daniel did not win because he predicted the bottom. He won because his plan did not require a prediction. Maya did not lose because she was foolish. She lost because fear gave her a decision that felt safe now, but became costly later. Never selling during a crash does not mean every investment is good forever. Companies can fail, bubbles can burst, portfolios can be too risky, and money needed soon probably should not be exposed to major market swings in the first place. But for long-term diversified investing, the history is surprisingly clear. The market's worst moments often sit right next to its best opportunities. And the hardest part is that you only know which was which after it's over. So maybe the real what if is not, what if you never sold during a market crash? Maybe it's this. What if the most powerful move in investing is the one that feels like doing nothing? Never selling during a market crash does not mean every investment will recover, but history suggests that for long-term diversified investors, staying put has often turned panic into patience, and patience into recovery. The real challenge is not predicting the bottom, but building a plan strong enough that doing nothing becomes possible when everything feels uncertain. If you found this useful, subscribe to What If Finance. New video every week.